Hello guys, Matthew here with another video. I'm going to be going over how we underwrite multifamily deals, particular value add multifamily at Superior Capital. So I've picked an example property I've never seen before. I just went to LoopNet, looked up multifamily property in Ohio, and picked one that seemed like it would have some value add potential. And then we're going to run the numbers, see if this is an actual deal, see if the numbers make sense, what the property is going to be worth when we're done stabilizing it, etc. So the spreadsheet I use for underwriting is Michael Blanc's calculator. I have no association with him. I've tried a few calculators, and this is the one that I found to be the best calculator for underwriting multifamily assets in particular. Especially if you're syndicating, it makes it a lot easier to run the numbers. But even if you're not syndicating, you can still use this calculator. I'll link to it in the description below. I have no affiliation with them other than the fact that I use the product and I like it quite a bit. So I start off in the scenarios tab. It has some different options here. I don't like to use the marketing package and all this stuff. I like to use best case, average case, and worst case. And these are like scenarios where like if things are going well, things are going poorly, if expenses are higher than we expect. Hide this column here. So first you're going to enter some basic details. Some of this are also questions about the loan you're going to be able to get. A lot of that has to do with you knowing where your balance sheet is, what relationships you have with banks, and knowing if you're going to be able to get this finance, what the interest rate's going to be, etc. Let's go back and look at the property real quick here. So we have a 24-unit apartment complex for $895,000, $37,000 a door, which is very, very low, but it's Toledo, which is a C minus, maybe D market, depending on the neighborhood. 14 minutes away from the University of Toledo. So let's see what we got here. They did attach a brochure in the form of a presentation, which I have here. So we'll just go over the property high level, and then we'll deep dive into the underwriting. 5311 North Detroit, 24 units. They're all one bedroom, one bath. Okay, built 1970, and the NOI is 47,000, which is super low. So I'm trying to see, is it vacancy? Is it below market rents? Are their expenses too high? But instantly I know, and this is more from experience than anything else, that a 47,000 NOI on a 24 unit is extremely low. So let's figure out what's going on here. So here we dive into some of the details, more into the building. Okay, let's hopefully they have financials. No, Siri, leave us alone. So we have the financials here. We have the income. So let's take the income and figure out on average what they're getting per unit. So they're getting 180, say 181,000 per year, divided by 12. Divide that by 24. So they're getting $628 per month in rental revenue on average per unit. Now, I want to see if that makes sense for the market. So let's hop into another tab here and look up apartments for rent. And then I'm going to type in this zip code here. The reason I do zip code is because it narrows it in, even with the city, might be a big city. I also skip apartments.com because they'll typically have like class A stuff, or I don't think there is class A in Toledo, but they'll usually have nicer stuff, but it can still give you an idea. But when you're doing rent comparables, you want to make sure you're comparing a property as similar as possible. You want to make sure that obviously you're getting a one bedroom because all of these are one bedroom. You also want to make sure that the amenities are the same. You're not going to compare it to a one bedroom apartment complex that has a pool. That doesn't make sense. So you want to find something as similar as possible. The reason I don't like apartments.com is it's usually best for comparing class A and class B. But for class C, I like to use, Trulia, Realtor, Apartment Guide. Those will give you pretty good ideas. Apartment Guide, we have 1 to 2 bedrooms, the one bath for $799. Seems on the higher end. Here we have one bedroom for $675. one bedroom for 500, and I think this one has some kind of amenities, has a pool, it looks like. 550. Ooh. So right off the bat, I'm thinking the rents where they are pretty close to what market rent is demanding. Maybe you can say I can get them up to 675 after repairing the units, 650 here, 610. Yeah, so I'm going to run under the assumptions here that the average rent per unit is going to be around 650. Now let's look at their expenses. Wow. So looking at their expenses as a whole, big picture, they're running 133. What is this now? They're running $133,839 in expenses annually, which is huge. So it looks like there's definitely some operational inefficiencies there. So they're running a 73% expense ratio. And for those that don't know, an expense ratio is simply saying what percentage of the income is being used towards expenses. For multifamily, it's between 40 and 50%, depending on how old the building is, what CapEx is coming. So for something like this, I'd expect 50%, but seeing that the building's operating at a 73% expense ratio is huge. So big picture, looking at this property, it looks like the opportunity is going to come from lowering the expenses and not so much raising the income. Seems like they're already close to market rent on this income. They are billing back some for utilities. They do have some late fee income, some pet fee income. Okay, now that we kind of have an idea of what the condition of the property is, not the condition, what the situation, big picture situation of the property is, we can go back to our underwriting spreadsheet and start plugging in numbers. So acquisition price, let's assume we're going to go in and offer asking. We can play with this as time goes on. What was that, 890, 895. And then we have 24 units, if I'm not mistaken. 24 units, okay. So I know for this property, I should be able to get 25% down. In this market, though, I may be able to get 30. So I'll leave that at 30% down. I don't like doing interest only. Now, repairs. This is a big one that you're really going to find out when you're under contract what repairs are. Once you're under contract, you can get a contractor out there to go and see how much it's going to cost to get the building where it needs to be. Now, since rents are already close to market, I'm not anticipating a major amount in repairs. I'm assuming that we're probably going to be keeping a lot of the tenants if we were to pick up this building. So I'm going to underwrite at $2,000 per unit. Now, this is just a number I'm throwing out. This could be way off. This could be over, but I need to plug something into the calculator to start running my numbers. So I'm gonna plug in $2,000 per unit, which would put us at $48,000 in repairs. Now, this number will change. We could go into under contract, get a contractor out there, do our inspection, and it turns out we need $100,000 in repairs. So I'll go in and update the spreadsheet once we have more data. Operating reserves, the rule of thumb we have at Superior Capital is $1,000 per unit for multifamily. So that would put us at $24,000 in reserves. This is just money we have in an account. Just in case anything goes wrong, any unforeseen situations come up, we're ready to handle it and we're protecting the investment. So estimated closing costs, that's on another tab, how that's calculated. Now, depending on whether you're syndicating the property or not, $43,000 could be on the high end. This also includes about $15,000 in attorney fees to draw up the PPM and the OM that would go out to the investors. Now, if you're not syndicating the property, closing costs are typically a lot less, maybe 2 to 3% of the purchase price. So let's go down. Gross potential rent. So we said 650. At 650 per unit times the 24 units, that puts our gross potential rent at 15,600 per month times 12, and that puts that 187,200, which actually isn't that far off from what they're already collecting. The main value add for this building is going to be the lowering these expenses. We'll deep dive the expenses in a moment, but using the expense ratio, we're able to tell, hey, they're spending 73% of the money that comes in on expenses. So there's a lot of leakage, I like to call, in the operations of running this property. So here we have vacancy. Give me a second. This is just calculator editing here. So I like to do 5, although it could be more, it could be less. Now, you could look up the market vacancy in Toledo and it'll tell you 10, 7, whatever. But a lot of this will have to do with operations. If you're aggressively marketing vacant units, putting them on all the sites, answering all the inquiries that come in, vacancy is an operations-based metric. So you can increase or decrease your property's vacancy rate by being good operators. So it's a C-class market, so I might be leaning more towards 7. Tenants are going to be coming in and out, especially as we go in. We may be raising rents on some of the tenants. Now, concessions is saying, okay, we're able to bring tenants in, but we have to offer 1 month free rent. Or there was an issue with the unit where the heat went down, so we gave them a credit. These are all concessions, things that we have to offer in order to keep that vacancy rate down, or there was issues with the property that we had to give tenants some credit back in the rent. I like to keep it at 3. 3% is usually a pretty reasonable number for this, especially after you do the major repairs up front. After you spend this 48 grand on the property, you should be able to keep concessions fairly low. Now we have all the expenses. Now this is how I personally do things. I don't like to deep dive every single line item at the beginning. I'm just trying to see if this is something I should even consider putting an offer on. So I like to use an expense ratio. So for multifamily, I'll choose between a 40% or a 50% expense ratio. So if the building is older, like this one, it's a 1970s building, I'm probably going to be sitting at the 50% expense ratio. So I'm essentially saying about half of this 187,000 that comes in is going to have to go towards expenses, including utilities, if any, including repairs, maintenance, insurance, all that stuff. It's going to be about 50% of the money that comes in. Now, this is just ballpark. Once you're under contract, you actually have to go and fill out each one of these line items. You actually have to figure out how much you're going to spend on utilities, how much you're going to spend on insurance, what the taxes is going to be, the newly assessed taxes. So I'll do that once I'm actually under contract, or I at least have an accepted LOI, a letter of intent, and attorneys are starting to draw up the purchase and sale agreement. But for now, I'll leave it at 50% just to see what the numbers are going to come to. So I'm anticipating spending 84,000 on expenses when they spent 133,000 on expenses. So before I make my offer, I'm going to deep dive all these line items and see what's going on here and why they're spending so much money on repairs and maintenance. Okay. So first, I'm just doing a quick rule of thumb, seeing how everything's going. Interest rate right now, I anticipate, knowing my lender, I'm going to be able to do 7.5%, and it'll likely be a 20-year amortization, not a 30. Maybe, actually, I just got 25 from my lender, so I'll assume I can do a 25-year amortization, which is a fancy way of saying over how many years is the loan going to be. With residential, 30 years, very common. Everyone's getting 30-year. With commercial, it's 20, 25, maybe 30 with some institutional lenders. Now, market cap rate. This is an item that will have a large impact on whether or not you purchase the property. Market cap rate is essentially saying, how much is the building going to be worth, or what cap rate is the building going to trade at once it's stabilized. Now, if you know the market, you probably already know this number. Now, I'm not too familiar with the Toledo market. So what I'm going to do is you can literally look up multifamily cap rate in Toledo, Ohio, and you'll get a bunch of different reports. So it looks like we're looking at an 8, Crexy's saying an 8. Loan rates. Now, there are some go-to sites that I like to use. There it is. We'll look at this one. NAR has one that comes out of all the major metro markets. I'll link to this one too. This one's it's free. It's on their site. Toledo. Yes, I don't know how to spell Toledo, but that's fine. And this will have all the data for all the different kind of asset classes, but I'm going to go to multifamily and I'm going to go to cap rate. Q4 2023, it was at a 9 cap. As you can see, cap rates are going up, which means property values are going down. So it looks like the cap rate is 9, which makes sense for the area being a C, D class area. So it looks like when the property is stabilized, that means after we can achieve this rent, after we can achieve a 50% expense ratio, the property will be worth $935,000. Okay, so already looking at this, they want $900,000 for the property. I'm anticipating putting in another $50,000 for the property. So I'm going to be all in $950, and then the building is going to be worth $935. So I'm already saying if I'm able to take this property over, raise the rent just a little bit, not much, probably find the people that have really low rent and raise their rent, massively taking down the expenses, the property is only going to be worth $935. So this deal is already a pass for me. I'm going to keep going just to show you like what my process is like when I continue underwriting the property. But just from this tab over here, just from going through the best case scenario, this is not a deal I'd want to look at. Now, with this being best case, I might put this one as 40, this one is 50, and then this one is 60. Now it's all dependent on the property. So if I'm able to get expenses down to 67,000, which is essentially cut the expenses in half, was what I'm saying, and take the NOI from 47,000 to 100,000. So the current NOI of the building, so they have current NOI is 47,132 divided by the purchase price. So they're trying to trade a property in a C minus area at a current NOI of 5.2%. Now, one of the reasons our firm is transitioning out of multifamily is because they trade at such ridiculous cap rates. So the going in cap rate is a 5%, and market cap rates is at 9%. So for this property to even make sense at a 9 cap, so what they should be trading the property at is $523,000. So I simply took the in-place NOI, divided it by the market cap rate, and now I know what the building would be worth if they actually did trade it at the market cap rate. Now, if you're doing a massive value add where there's a lot of room to add value, it's okay to purchase a property at a 5 cap or a 4 cap, and then once you add the value, it'll be worth substantially more. But especially from an income perspective, this property is already fairly stable for that market. Now, the expenses, we'll dive into that in a moment, are way over what they need to be. But it could just be that the previous owner invested a lot of money into this property in the past year in order to get it where it needs to be. That's my assumption here, but I haven't even dived into the expenses yet. So right off the bat, best case scenario, we're able to get expenses super low. We can get this property to be worth 1.1 million. Average case at a 50% expense ratio. Let's keep this. So the only thing we're really playing with are the expenses. At a 50% expense ratio, it's valued at 930. And then if expenses are high, at 100,000, 60% expense ratio, we're looking at the building being worth around 750 grand, which is actually less than what they're asking right now. So right off the bat, if I'm looking to place capital, I'm walking away from this deal, and I'm going to move on to the next one. But let's move on real quick just to play with some things. There are some things that are still out of whack. Like I know this estimated closing cost is high because it's assuming syndication. So I'm going to dive into here and see like what are the details. Now, populate with scenario. This is saying which of these numbers should we use? I typically use the average case, which would be scenario 2. So this is assuming it's a syndication with 80-20 syndication. That's the default that's plugged into the calculator. But let's assume we're not going to be syndicating this property and there will be no asset management fee. So this is how much you'll need to close. You'll need 400,000 to close. Actually, let me adjust something. Since we're not syndicating the property, we can take the legal fees, LLC PPM, down to zero. And these are kind of just auto-filled rule of thumbs. This was filled out by the calculator already, and they had thousands of data points. So I found this to be fairly close. The smaller the deal, the more you'll want to adjust these. Some of these are high. Like I know the appraisal probably won't cost 3,000. And as I actually get these numbers, when you're under contract, I'll go in and keep adjusting these through the escrow period. So by the time we close, I have my underwriting dialed in. I have all my expenses filled out, and I'll also know exactly what the acquisition costs are going to be. How much we're going to spend on appraisal, how much we're going to spend on environmental, and all of these are going to get done. These are likely high because the property it's only $1 million property, so this is likely on the higher end. Because there is a lead-based inspection, there is going to be a lead-based inspection here, but 28,000 for closing costs. The rule of thumb is 2%. So we'll 950, or what was it? 895. 895 times 0.02. So yeah, this is around 10 grand higher than it should be. But it's better to overestimate than to underestimate. So when all said is done, you're going to need 387. I'd say 400,000. My raise would be 400,000 for this property. So we're looking at a 7% cash on cash return after the property stabilized. The average annual return is fairly low. The total return on investment is higher, but a lot of that depends on how long you're going to hold the property. So the exit strategy here is another important part to fill out. So this is saying when you plan on having major events. So we're saying we're not going to be doing a cash out refinance, and we're going to be selling the property after 5 years. I like to underwrite a 2-year, year 2 refinance, 5-year exit, and it really depends on what your strategy is. If you plan on holding this property for 10, 12, 20 years, do you plan on adding value and then refinancing after 2 or 3 years? So it really depends on your strategy. And you'll go in and fill out all of these details here. So to summarize, I mean, you could dive into each one of these tabs and figure out what the returns are going to be year after year, after the refinance, before the refinance. But the scenario tab is where the deal lives or dies. So you see how much you're actually going to be able to make from a cash flow perspective and the net operating income. So this property is going to have, after the debt service, which is your monthly payment for the mortgage, this property is going to make very little money. With best case scenario, you're making $4,000 a month. The average case, you're making 2 and change. And then with the worst case scenario, I don't know why it says worst case, you're making about $1,000 a month. And so this property kind of died at the initial underwriting level. And then as you get the property under contract and you start plugging these numbers in, then deals will continue to die through the underwriting or through the escrow period. That's why you need to make sure you have a inspection period in which you can get out of the contract. If, for example, if the deal did work at $48,000 worth of repairs, but then you figure out it's actually 100,000, you update your underwriting, your cash to close will go up, your cash on cash return will go down. So you continue playing with these numbers once you're under contract. So let's dive in. I'm very curious on why they're spending so much money, how they're spending $133,000. Okay, so it looks like they have a decent amount of bad debt on the property. So I'm assuming it's some kind of hard money lender that they have on the property where they're spending a lot of money in interest every month. Okay, they have employees, that's quite a bit. So they have employees and management. Maintenance is 12,000. So yeah, they spent a decent amount last year on repairs and maintenance, but they're also spending way too much on employees. They're spending way too much on Management, I mean, either have one or the other. If you have management, you shouldn't have employees. Appliances, insurance. Yeah, so with the combination of a lot of repairs and bad debt, I'm guessing they're in some kind of hard money, and overspending on management and labor, you have this massive, massive expense where they're spending 70% of their income. Now, if I really wanted this property, I might come in and put an offer at 600, which very likely they'll tell me to go to hell. But honestly, that's what this property is worth. The market cap rate is 9%, and based on what their NOI currently is, that's all I can really offer for this property. So I'd be surprised if this property sold at the price they're asking. So maybe just add it to a watch list, and in 2, 3, I don't know how long this one's been listed for, but in another 2, 3, or 4 months, if the property hasn't sold, maybe place an offer for 5 or 600 grand. I mean, the parking lot's probably going to need to be redone. That's 10 grand by itself at least. So underwriting is quite simple. You need to figure out, what the stabilized rents are going to be, and then you plug in an expense ratio. This is back of the napkin underwriting. You plug in an expense ratio and see if the numbers make sense at all. This one, it clearly doesn't. It's going to be worth $935 after stabilization, and with a purchase price of $900, and at least my guess would be $50,000 to get the building stable. You're already all in at $950, so there's no room to really make money here. So this one's going to be a big pass in my book, but I might have to underwrite 50, 60 buildings before I'll put in one offer. Depending on interest rates, this also will have a pretty big effect. As interest rates get lower, the numbers make more sense on more deals. I'm able to put in more offers, but as it stands here, I might put in 50, 60. I might have to underwrite 40 to 60 properties before I feel comfortable putting in one offer. But that's the game. That's what underwriting is. You're just going to go in and run the numbers real quick, see what the property is going to be worth when it's stable. And this is for multifamily. I use the same spreadsheet, but with quite a bit of edits for other types of commercial assets like retail and industrial. But this one is built out already for multifamily. But yeah, I hope you guys enjoyed the video. I just really quick picked a random property off LoopNet, plugged it in the calculator, did exactly what I would do to see if this is a property I'd want to put an offer on. And I hope this can help you guys in your underwriting. Yeah, so like, subscribe. I'm going to be trying to do more underwriting videos. A lot of people, it's a part of the process in which they stop. They don't know where to go any further, knowing whether or not this is actually a good deal. So I'm going to try to help some fellow investors out with that. If you have any questions or concerns, I'll be answering in the comments below. But yeah, like, subscribe. I'll be coming out with a lot more underwriting videos, different asset classes, and yeah, I'll catch you guys on the next one.